How did governments get so addicted to debt? It all started with an idea so radical it reshaped the world's economy forever. In the late 17th century, England was broke and desperate for cash to fund its war against France. A Scottish merchant named William Paterson came forward with a genius, almost diabolical proposal. He told the government, "I'll get you the loan you need, $1.2 million in gold. But here's the catch. You will never, ever pay it back." Instead of repaying the principal, the government would pay 8% interest on the loan every single year, forever. To manage this bizarre arrangement, Paterson suggested creating a brand new institution, the Bank of England. The system was elegant. Wealthy merchants would deposit their gold with the new bank. The bank would then lend that gold to the government. The government, in turn, would use its tax revenue to pay the annual interest, and the bank would distribute that interest back to the merchants. The key was that the principal was never to be repaid. It was a permanent loan by design. Why would anyone agree to this? Because the interest payments were guaranteed by Parliament itself, backed by the full faith and credit of the government's ability to tax its citizens. As long as England could collect taxes, the interest would flow. The banknotes the lenders received were not just IOUs. They were tradable, functioning like currency, but even better because they earned interest. In 1694, Parliament approved the scheme. The Bank of England was born, merchants handed over their gold, and the government got its war money. For the first time in history, national debt wasn't a problem to be solved, but a permanent feature of the financial system. But here's where Paterson's brilliance truly shines, a detail often missed by historians. The government paid 8% interest on $1.2 million, which is $96,000 per year, in perpetuity. The merchants had essentially purchased a government-backed annuity. But Paterson's real masterstroke came next. The Bank of England was authorized to issue its own paper banknotes, backed not by gold, but by the government's debt. They could literally print money up to the value of the loan. This mechanism created money out of thin air, from debt itself. The government's IOU became circulating currency. The more the government borrowed, the more money could be created. This model was so successful that within 50 years, every major European power had copied it. France, the Netherlands, and even the newly independent United States, where Alexander Hamilton explicitly modeled America's financial system on the Bank of England. Paterson himself didn't die a wealthy man, but the system he engineered is still with us over 300 years later. The Bank of England still operates, and British government debt has never been paid off. It's just been refinanced and expanded. The debt trap was set in 1694, and nearly every government has willingly walked into it. Fast forward to the early 1800s. Governments were borrowing heavily, but the market was a chaotic mess. Only the super rich could play the game. Then, a man named Nathan Rothschild stepped in and industrialized the entire system. He turned messy government debt into a clean, tradable product. The Rothschild family built an unparalleled banking network across Europe, with branches in London, Paris, Vienna, and beyond. This gave them unmatched financial reach and, more importantly, information. During the Napoleonic Wars, Nathan Rothschild pioneered a new strategy. Instead of just lending money, he would buy up government bonds at a massive discount when war and panic drove prices down, then sell them for a handsome profit when peace and confidence returned. He essentially created the secondary market for government debt. Governments got their cash up front, investors got a tradable asset, and Rothschild captured the difference. The most legendary example was at the Battle of Waterloo. Thanks to his private courier network, Rothschild knew Napoleon had been defeated long before the official news reached London. He reportedly used this inside information to manipulate the market, first selling bonds to create a panic, then sweeping in to buy them back at rock-bottom prices. The profits were immense, but more importantly, it was a stunning demonstration of how powerful information was in the new world of finance, a world built on the foundation of permanent government debt. What if I told you the world's financial system wasn't built for your benefit, but to trap governments in a permanent cycle of debt? It all starts in the 1800s with the Rothschild family. Their genius wasn't just in lending money to kings and countries. It was in weaving a web so intricate that if any single government dared to default, it would crash the entire European economy. They made sovereign debt a system where everyone was connected, and failure was not an option. Governments weren't just borrowing. They were locked into a network that guaranteed repayment. By the mid-19th century, the Rothschilds were financing everything from railroads to wars, effectively industrializing national debt. Now, let's jump across the Atlantic to the early 1900s. America had a problem. Its banking system was a chaotic mess of thousands of independent banks. There was no central authority, no one to steer the ship during a storm. The legendary financier J.P. Morgan didn't see this as a flaw. He saw it as a massive opportunity. An opportunity not for the public good, but to centralize and consolidate banking power for himself and his peers. His chance came with the Panic of 1907. The stock market crashed. People rushed to pull their money out of banks, and credit completely dried up. The economy was on the verge of total collapse. Who stepped in? J.P. Morgan. Using his own vast fortune and immense influence, he personally organized a bailout, strong-arming other bankers to prop up failing institutions. For a brief moment, J.P. Morgan was America's central bank. But this crisis taught him a crucial lesson. A temporary fix wasn't enough. The system needed a permanent structure, one designed and controlled by bankers, not by politicians. This led to one of the most secretive and influential meetings in financial history. In November 1910, a group of the world's wealthiest men gathered on a private island off the coast of Georgia, Jekyll Island. They represented nearly a quarter of the entire world's wealth at the time. Their mission? To design America's central bank from the ground up. They were clever about it, creating a system that looked decentralized, with regional banks and government oversight to appear democratic. But the real power, the operational control, was designed to stay firmly in the hands of the banking elite. Their masterstroke was this: the new entity, the Federal Reserve, would have the power to create money out of thin air to buy government bonds. Think about that. This meant the government could borrow without any practical limit. If private investors didn't want to buy government debt, the Fed could just step in and print the money to do it. In December 1913, Congress passed the Federal Reserve Act, and the system was born. J.P. Morgan died just a few months before it was signed into law, but his vision became the bedrock of modern American finance. The era of theoretically infinite government debt had begun. Fast forward to the 1970s, and this system goes global. Developing nations, hungry for growth, took on massive loans, mostly in US dollars, at what seemed like cheap interest rates. It felt like a golden ticket to industrialization. But then, the trap snapped shut. The U.S. was battling crippling stagflation, and the Federal Reserve Chairman, Paul Volcker, made a ruthless decision. To crush inflation at home, he jacked up interest rates to an unbelievable 20%. For Americans, it meant a painful recession. But for those developing nations that had borrowed in dollars, it was an economic apocalypse. Their debt payments skyrocketed overnight. Imagine your mortgage rate jumping from 5% to 20% with no warning. Countries were going broke. Mexico defaulted in 1982, and the rest of Latin America was on the brink. A global debt crisis was about to explode, threatening the very American and European banks that had issued the loans. So what did Volcker do? Did he let the countries default and the banks take their losses? Of course not. He orchestrated a new plan through the International Monetary Fund, the IMF. The IMF would provide emergency loans to prevent the defaults. But these weren't rescue packages for the struggling nations. They were bailouts for the Western banks, ensuring they got every last cent of their interest payments. The developing world was trapped, forced into austerity and decades of paying off an unpayable debt, all to protect the system created a century earlier. From Rothschild to the Fed to the IMF, the story of debt has always been about power, control, and ensuring the system always wins. How do you get a country to pay back its debt forever? You don't threaten them. You trap them. In the 19th century, the Rothschild family pioneered a brilliant and terrifying financial system. Their lasting contribution wasn't just lending money to governments. It was making sovereign debt so interconnected across nations that if one major government defaulted, it would trigger a cascade of failures, bringing down the entire European financial system. Governments weren't just borrowing. They were locked into a network where default meant continental economic collapse. They were effectively trapped into permanent repayment. By the mid-1800s, the Rothschilds were financing governments, building railroads, and funding wars, turning sovereign borrowing into an industrial-scale enterprise. Fast forward to the early 1900s. America had a problem. Its banking system was fragmented, with thousands of independent banks and no central authority. There was no one to coordinate credit, manage a crisis, or guarantee the market for government debt. The great financier J.P. Morgan saw this not as a weakness, but as a golden opportunity. The panic of 1907 proved his point. A stock market crash triggered widespread bank runs. Credit froze solid. The economy teetered on the brink. In a display of immense power, J.P. Morgan personally orchestrated a bailout, using his own capital and influence to prop up failing institutions. He literally became America's central bank for a moment. But Morgan knew a permanent solution was needed, one controlled by bankers, not politicians. So, in November 1910, a secret meeting took place on Jekyll Island, Georgia. Morgan's top allies, representing about a quarter of the world's wealth at the time, gathered to design a central banking system for America. They were meticulous, crafting a system that appeared decentralized and under public control. But the real power, the operational control, would remain firmly in the hands of the banking establishment. They called it the Federal Reserve. Its most critical innovation? The Fed was authorized to purchase government bonds with money it created out of thin air. This meant there was no practical limit to government borrowing. As long as the Fed existed, there would always be a guaranteed buyer for U.S. debt. Congress passed the Federal Reserve Act in December 1913. The government could now borrow continuously, knowing the Fed could always step in. American debt, once limited, became theoretically infinite. By the 1970s, the system had gone global. Developing nations, eager to industrialize, borrowed heavily, mostly in U.S. dollars at what seemed like low interest rates. Then, the trap snapped shut. The U.S. was hit by crippling stagflation. To crush it, Federal Reserve Chairman Paul Volcker made a ruthless decision. He jacked up interest rates to unprecedented levels, hitting 20% by 1981. For Americans, this meant a painful recession. For the developing world, it was an economic apocalypse. Their debt payments, denominated in dollars, exploded overnight. Imagine your mortgage rate jumping from 5% to 20%. Countries couldn't cope. In 1982, Mexico defaulted, and a global debt crisis threatened to take down the major American and European banks that had made the loans. But Volcker wasn't about to let those banks fail. Instead of allowing defaults, he used the International Monetary Fund, or IMF, to orchestrate a new plan. The IMF would provide emergency loans to prevent countries from defaulting. But here's the twist. These weren't rescue packages for struggling nations. They were bailouts for the Western banks. The new loans were used to ensure the banks got their interest payments, while the developing countries were forced into decades of austerity and economic stagnation, all to service a debt they could never escape. The trap that was set for European nations a century earlier had now been perfected and deployed on a global scale. This is the hidden architecture of modern finance. A system designed not just to lend, but to ensure that the debt is permanent, the interest is always paid, and the power remains in the hands of those who control the money supply. Let's talk about the impossible trap that holds nearly every country on Earth. It wasn't an accident. It was built piece by 4 key figures over 300 years. And today, we're all living inside their creation. It starts in the 1980s. The conditions were brutal. The International Monetary Fund, the IMF, demanded developing nations privatize everything, slash government spending and gut worker protections. Why? To get loans to pay back Western banks. But it was a vicious cycle. Borrow from the IMF, implement devastating reforms, watch your society crumble, then borrow even more just to stay afloat. The cycle never ended. The man who locked this trap in place was Paul Volcker, former head of the U.S. Federal Reserve. In 1982, his policies made this debt trap global and permanent. Developing nations could never truly escape. If they tried to default, the IMF would step in. But IMF intervention wasn't a rescue. It was a life sentence of debt servitude and lost economic independence. This global system didn't just appear overnight. It has deep roots. Let's rewind. Architect number 1, William Paterson. In 1694, he helped create the Bank of England. His innovation? Permanent government debt. The idea was that governments would never pay back the principal loan. They would only pay the interest on it forever. This created a perpetual stream of income for the lenders. Architect number 2, Nathan Rothschild. In 1815, after the Battle of Waterloo, he used his vast financial network to make government debt global and interconnected. His innovation meant that if one major country defaulted, it could trigger a catastrophic domino effect, bringing down the entire system. This effectively trapped all governments. No one could risk a collapse. Architect number 3, J.P. Morgan. In 1913, he was a key player in the creation of the U.S. Federal Reserve. His innovation? Infinite debt. Central banks were given the power to create unlimited money out of thin air, which they could then use to buy government bonds. This meant there was no limit to how much a government could borrow. And that brings us back to our fourth architect, Paul Volcker. In 1982, he made the debt inescapable. International institutions like the IMF would prevent any country from defaulting, but the price was permanent subjugation to their lenders. So let's connect the dots. 4 men, 4 crucial innovations, 1 seamless global system. Paterson made debt permanent. Rothschild made it global. Morgan made it infinite. And Volcker made it inescapable. Today, the world is swimming in over $315 trillion of debt. Let me be clear. None of that will ever be fully repaid. It's not designed to be. All of it exists to generate interest payments forever. This isn't a flaw in the system. It's not a bug. It's the primary feature. This isn't a crisis waiting to happen. This is the system functioning exactly as it was designed. Every single government on Earth, from the smallest nation to the largest superpower, operates within this framework. Debt is not a problem to be solved. It's a product meant to grow. The interest isn't meant to stop. It's designed to flow perpetually upwards from the many to the few. These 4 architects built a machine that runs on debt, is powered by interest, gets maintained by periodic crises, and is locked in place by one simple, terrifying fact. Trying to dismantle it would collapse the entire global economy as we know it. So when you hear about the $38 trillion US national debt and wonder how we'll ever pay it back, you're asking the wrong question. It was never meant to be paid back. It's not a problem. It's the system working perfectly, just as 4 men across 3 centuries intended it to. They didn't break the system. They are the system. And now you see it too. If this changed how you see the world, make sure to like and subscribe for more content that peels back the layers of how our world really works. Thanks for watching.